March 2020. The COVID-19 pandemic hit the world. The economy stopped. Unemployment broke records. The public was in panic. Federal Reserve Chairman Jerome Powell held a press conference and said this: "There's no concern about us running out of money. We print digitally, we print physically, we can create unlimited money." And that's exactly what they did. Between March and December 2020, the Federal Reserve printed $3 trillion. In 2021, $2 trillion more, a total of $5 trillion. Money printing on a scale never seen in America's history. Now let me ask you a question. Where did this $5 trillion go? To you? No. Did $50,000 get deposited into your bank account? No. Then where did it go? First, to the banks. The banks used this money to lend to the ultra-rich at interest rates between 0.5% and 2%. The rich used that money to buy stocks, real estate, and companies. Asset prices exploded. Between 2020 and 2024, the S&P 500 rose 100%. Real estate prices increased by an average of 40%. Bitcoin went from $7,000 to $100,000. The total wealth of billionaires jumped from $5 trillion to $14 trillion. And your salary? It rose by an average of 15%, but inflation rose by 23%. So your real purchasing power fell. You are working more, but you can buy less. Why? Because you are the last stop for money. Before you, the rich got it, asset prices inflated, inflation started, and when you finally received the money, you were already facing inflation. This is called the Cantillon Effect, and it has been the largest wealth transfer mechanism in the world for 300 years. In the next 15 minutes, what I will show you is exactly what the Cantillon Effect is, how it brought down empires in history, how it worked in the 2008 and 2020 crises, and how you can protect yourself in the next crisis. This is not just economics. This is the explanation for why your life becomes harder every year. The Cantillon Effect was discovered by the 18th century Irish-French economist Richard Cantillon. While studying the Mississippi bubble crisis that took place in France in the 1720s, he noticed something. When the money supply increased, not everyone became richer at the same time. The first owners of the money became richer, while the last owners became poorer. The Mississippi bubble unfolded like this. The French government gave a Scottish banker named John Law the authority to print money. Law founded a colonial trading company called the Mississippi Company and convinced the public to buy shares of the company. Share prices multiplied. Everyone thought they were getting rich. But then Law printed more money. Inflation began. Bread prices rose by 400%. The public panicked and started selling shares. In 1720, the bubble burst. Thousands of people lost their wealth. As Cantillon analyzed this crisis, he realized this. When new money entered the system, the palace bankers and merchants were the first people it reached. They spent it before prices rose, but groups like workers, farmers, and consumers were the last to receive the money. They received it after inflation had already started. Result, the first receivers got richer, the last receivers got poorer. Cantillon wrote this in his book Essai sur la nature du commerce en général. It was published in 1755, but for 270 years, economists ignored this effect. Why? Because this effect showed that monetary policy was not neutral. On the contrary, it made the rich richer and the poor poorer. Today, when central banks print money, they say, "We are stimulating the economy." But the truth is, the entry point of money determines everything, and you are never at the entry point of money. Let's see step by step how money enters the system. This is the darkest secret of the modern financial system. Stage 1, the Federal Reserve prints money. Central banks press a button on a computer. New money is created. This money is first recorded on the central bank's balance sheet. It is not yet in anyone's hands. Stage 2, banks receive the money. The Fed gives this new money to major commercial banks. JPMorgan, Goldman Sachs, Citibank, Bank of America. Banks receive this money at almost zero interest. Between 2008 and 2021, the Fed's interest rate was between 0% and 0.25%, so banks got money for free. Stage 3, the rich take loans. Banks lend this money to the ultra-rich, hedge funds, and large companies at 0.5% to 2% interest. Warren Buffett's Berkshire Hathaway can borrow billions from banks at 1% interest. But when you want to get a mortgage from the same bank, you pay 6% to 7%. Stage 4, asset prices explode. The rich invest the cheap credit they receive into stocks, bonds, real estate, and other assets. Demand rises, prices rise. In 2020, the S&P 500 rose 100%. Real estate rose 40%. The rich got richer. Stage 5, companies raise prices. As asset prices rise, companies' costs rise. Rent, raw materials, energy become more expensive. Companies pass this cost on to consumers. Bread, milk, gasoline prices rise. Stage 6. The middle class feels inflation. When the money reaches your wages, inflation has already begun. What you bought for $100 the previous year, you now buy for $125. Your wage may have increased by 10%, but your purchasing power has fallen. This hierarchy is intentional. The system is designed this way. The rich receive first money, you receive last money, and last money is never as valuable as first money. When Jerome Powell said in 2020, we can print unlimited money, what he was actually saying was, we can make unlimited wealth transfers to the rich. But nobody says it that way. The Cantillon Effect is not new. It has been seen in every era of money printing in history. Here are 3 striking examples. The first example is the Roman Empire between the years 200 and 300 AD. In AD 64, Rome's denarius coin was 95% pure silver. By the time you reached AD 200, it had fallen to 50%. In AD 250 to 5%. The empire was debasing its currency to finance the army and bureaucracy. Who won? Senators, landowners, generals. They received the new coins first and bought land, slaves, and luxury goods before prices rose. The public struggled with inflation. Bread prices rose by 1,000% over 100 years. Result: wealth concentrated in the imperial elite. The middle class disappeared. People died of hunger, and the empire collapsed. Now, let's look at Weimar Germany between 1921 and 1923. After World War I, Germany could not pay the war reparations of the Treaty of Versailles. The government started printing money. In 1921, 1 mark was $0.25. In 1923, $1 became 4.2 trillion marks. Who won? Big industrialists, debtors, those who acted early and moved into foreign currency or gold. Industrialists like Hugo Stinnes borrowed in marks and bought factories. They repaid their debts with money that was being devalued by hyperinflation. Their wealth multiplied. Who lost? Savers, retirees, salaried workers. A teacher's annual salary in 1923 was not enough to buy a loaf of bread. The middle class was completely erased. Result: social chaos in Germany. Hitler's rise, World War II. Finally, Zimbabwe between 2000 and 2009. The government of Robert Mugabe printed money to finance land reform and government spending. In 2008, Zimbabwe's inflation rate was officially 231 million%. According to unofficial estimates, 89.7 sextillion%. Who won? Businessmen close to the regime, those who dollarized early, those with offshore accounts. They immediately converted Zimbabwe dollars into foreign currency. Who lost? The public. A loaf of bread cost 300 billion Zimbabwe dollars. Wages lost value every day. Savings evaporated overnight. Result: the country's economy collapsed. In 2009, the Zimbabwe dollar was taken out of circulation. The pattern is the same. Money printing always makes the rich richer and the poor poorer. Because the rich get the money first and protect themselves from inflation. The poor get the money last and pay the bill for inflation. Now let's come to recent history, the 2008 financial crisis. This is the clearest modern era example of the Cantillon effect. During the Alan Greenspan and Ben Bernanke era, the Fed kept interest rates low. A cheap credit boom occurred. Everyone bought homes. The mortgage market inflated. Banks turned risky loans into safe financial products. In 2007, the bubble burst. Lehman Brothers collapsed. Bear Stearns collapsed. AIG collapsed. Stock markets crashed. People lost their homes. Ben Bernanke launched the quantitative easing program. The Fed printed $4 trillion. But where did this money go? First, to the banks, JPMorgan, Goldman Sachs, Citibank. The banks were rescued. They said, too big to fail. Rich bankers were rescued with taxpayer money. Then, to asset purchases. The Fed bought mortgage-backed securities, MBS, and Treasury bonds. Bond prices rose. Interest rates fell. Stocks soared. Who won? Wall Street. Between 2009 and 2019, the S&P 500 rose 400%. Billionaires tripled their wealth. Jamie Dimon, Lloyd Blankfein, Warren Buffett, everyone made billions. Asset owners, owners of real estate, stocks, bonds got richer. BlackRock, Vanguard, hedge funds posted record profits. Who lost? The middle class. 10 million Americans lost their homes. Unemployment rose to 10%. Wages stagnated. But when home prices rose again, they no longer had the money to buy. Savers. Because the Fed cut interest rates to zero, earnings from savings accounts were zero. Retirees lost their income. The younger generation, those who graduated in the 2010s, couldn't find jobs, stayed in debt, couldn't buy homes. The lost generation. Result? The 2008 crisis multiplied wealth inequality. While the wealth of the top 1% rose 40%, the wealth of the middle 50% fell 10%. Section 4. The 2020 pandemic, the largest wealth transfer in history. The 2020 pandemic ran the Cantillon effect in turbo mode. COVID-19 hit the world. The economy stopped. Stock markets crashed. The S&P 500 fell 34% in 1 month. Panic was everywhere. Jerome Powell started the most aggressive money printing in history. Between March and December 2020, $3 trillion, and in 2021, $2 trillion more. Total $5 trillion. Also, for the first time, the Fed began buying corporate bonds. It bought Apple, Microsoft, Amazon bonds. It even bought junk bonds. It hired BlackRock to buy bonds. Results: who won? Billionaires. Between 2020 and 2024, the total wealth of billionaires rose from $5 trillion to $14 trillion. Elon Musk's wealth jumped from $25 billion to $250 billion. Jeff Bezos from $75 billion to $200 billion. Warren Buffett from $67 billion to $130 billion. Technology companies, Apple, Microsoft, Amazon, Tesla, Nvidia, their stocks rose between 300% and 1,000%. Their CEOs made billions. Real estate investors, giants like Blackstone and BlackRock, bought homes in bulk as they became cheaper. While the average home price was $280,000 in 2020, it rose to $420,000 in 2024, a 50% increase. Bitcoin and crypto investors. Bitcoin was $5,000 in March 2020. By 2024, it reached $100,000. Early investors made 20x gains. Results: who lost? Small businesses. 200,000 small businesses closed permanently. But Amazon, Walmart, Target made record profits. Renters. Rent prices increased by 40%. While the average rent was $200 in 2020, it rose to $1,700 in 2024. Salaried workers. While wages rose by an average of 15%, inflation rose by 23%. Real income fell. People can work more and buy less. The younger generation, home prices doubled. While in 2020, the average home price was 4 times annual income, by 2024, it became 6 to 8 times. Buying a home became impossible. Oxfam's 2023 report. During the pandemic, the richest 1% of the world captured 63% of global wealth. The remaining 99% got only 37%. This is not a coincidence. This is the Cantillon Effect. The money went to the rich first and to you last, and you faced inflation already. The most painful result of the Cantillon Effect is this: the gap between asset inflation and wage inflation. Money printing first inflates asset prices. Stocks, bonds, real estate, gold, crypto. If you own these, you get richer. If you invested $100,000 into stocks in 2010, today you would have $500,000 without doing anything. But wages, stagnant. Between 1980 and 2024, the average American wage, adjusted for inflation, rose only 10%. 10% in 44 years. An average increase of 0.2% per year. Yet productivity rose 70%. So workers produced 70% more, but their wages rose 10%. Where did the difference go? To shareholders, to CEOs, to the rich. In 1980, a CEO earned about 30 times the salary of the average worker. Today, 350 times. Result: those who own assets get richer, those who do not own assets get poorer. If you own a home, its value doubled and you feel like you got richer. But if you are a renter, you work more to pay rent, but you will never be able to buy a home because home prices rise faster than your wages. This creates an intergenerational wealth gap. Baby boomers, 1946, 1964. They bought homes cheaply, they gained value. They retired, they are rich. Generation X, 1965, 1980. They could still become homeowners, but they struggled more. Middle class, millennials, 1981, 1996. Most could not become homeowners, buried in student debt. The first generation that is economically poorer than their parents. Generation Z, born after 1997, they can't even dream of buying a home. They work temporary jobs in the gig economy. The future is hopeless. The Cantillon Effect is an intergenerational wealth transfer. The old generation owns assets. The new generation is debt slaves. When Federal Reserve chairs defend money printing, they use the concept of the wealth effect. Let's explain it. The wealth effect theory says, if asset prices rise, people feel richer and spend more. Spending increases, the economy grows, everyone wins. Sounds logical, right? But what happens in reality? When asset prices rise, only asset owners get richer. In America, 90% of stocks are owned by the richest 10%. So when the S&P 500 rises 100%, only the rich 10% wins. But inflation affects everyone. When milk, bread, gasoline become more expensive, everyone pays more. The rich 10% doesn't feel it because it is a small portion of their income. But the bottom 50% spends 70% of its income on food and housing. Inflation crushes them. Result, the wealth effect works only for the rich. For the middle class, it creates a poverty effect. Jerome Powell said in 2020-2021, inflation is transitory. In 2022, when inflation rose to 9%, he said, "We were wrong." But the truth is, he didn't lie. He just spoke the language of the 1%. For the rich, inflation was transitory because their wealth is in assets. For the middle class, inflation was permanent because wages never caught up. Those who understood the Cantillon Effect searched for a solution, money that is not under the control of the central bank. Bitcoin was created in 2009 by Satoshi Nakamoto. The first sentence of the white paper, a purely peer-to-peer electronic cash system, meaning directly between people without a central bank. Bitcoin's supply is limited, 21 million. No central bank can press a button and create more Bitcoin. This is a protection against the Cantillon effect. But Bitcoin created its own problems too. Early adopters got rich. The first people who bought Bitcoin are billionaires today. Those who came late bought expensive. Volatility is extremely high. It can fall or rise 20% in a day. This makes it not a store of value, but a speculative instrument. Institutional capture. BlackRock, Fidelity, Wall Street launched Bitcoin ETFs. Bitcoin is no longer money without a central bank. It is an institutional asset class. Result, Bitcoin is not a solution to the Cantillon effect, maybe an alternative. But it created its own Cantillon effect. Early buyers are rich, late buyers lose. The real solution is for money printing to be subject to democratic oversight. But this is something those who hold power will never accept. What can you do individually against the Cantillon effect? Strategy 1. Own assets. If money sits in your wages, it melts with inflation. But if it sits in assets, it gains value. Stocks, real estate, gold, silver. These protect against inflation. Strategy 2. Use borrowing wisely. If inflation is coming, borrowing makes sense because your debt loses value over time. Those who took mortgages at 3% interest in 2020 won today because inflation became 23%, but their debt stayed fixed. Strategy 3. Be first money. If you can do entrepreneurship, start your own business. Don't be salaried, because salaried people are always last money. Entrepreneurs, investors, business owners are first money. Strategy 4. Get financial education. Be among the 1% who understand the Cantillon effect. Most people don't know this mechanism. You gain an advantage because you know it. Strategy 5. Turn to physical assets. Digital assets can be manipulated, but physical gold, silver, land cannot be manipulated. When the 2026 crisis comes, physical assets will be the safest haven. But remember, you can protect yourself individually. But as long as the system does not change, the Cantillon effect will continue. Conclusion: stop being last money. The Cantillon effect is the largest wealth transfer mechanism of the modern world. Richard Cantillon discovered it 300 years ago. It happened in Rome, it happened in Weimar, it happened in 2008, it happened in 2020. And it will happen again in 2026. When money is printed, the rich get it first. Asset prices inflate, inflation begins. And when you receive your paycheck, everything has already become more expensive. This is not an accident. This is the design of the system. Jerome Powell, Larry Fink, Jamie Dimon, Warren Buffett, they are all first money, your last money. But now you know. And knowledge is power. In the next video, what I will show you is the 2026 everything bubble. Stocks, bonds, real estate will collapse at the same time. When the crisis comes, there will be nowhere to run. Be prepared. Subscribe to Dark Money Historian. Tell me in the comments, did you know about the Cantillon effect? How do you protect yourself? Because the answers are not hidden in the future, they're hidden in the past. And history is repeating right now.